Hey everybody, my name is Ryan Liszeski. I'm with Champions Mortgage. We are a local mortgage lender based right here out of Seminole, Florida. What we can do for you at Champions Mortgage is we can take you through the entire buying process. We're here to help you from step one all the way to closing. We can't wait to help you on your next purchase. If you're looking to purchase a home in this market, be ready for what's going to be an amazing year. From the start, I'm going to walk you through each piece of that process, from assets to income, to how we're going to fit you into the best program possible to help you not only save money monthly, but also make sure you're saving money in your pocket. We don't want you to come out of the house having nothing in savings, but also being in an uncomfortable monthly payment. This year, there's still advantages. You'll still be able to see a chance to get seller credits. So we'll say that perhaps you get some seller credits. How awesome is that? If you're an FHA buyer, you have a chance to achieve 6% in seller credit. Now, the downfall is you don't get to use all of that towards your closing costs. You're probably only going to be able to use about 3 to 4%. So what do we do with the other 2 or 3? Not a problem. You're able to use that money to help lower your interest rate, which in turn lowers your monthly payment. How does that work, you say? This is where I come in. I'm going to come in and say, hey, you can use $5,000 to lower your monthly payment. It's going to lower your interest rate. On average, you're going to take 2% seller credit, and it's going to be able to lower your interest rate 1%. You're going to say, what kind of savings is that, Ryan? Those are all crazy numbers. Roughly, you're saving about $230 to $246 a month. That's a huge savings for you. Now, if you want to use more than that, we'll discuss that during the process. But on average, you're going to save $230 to $240 when it comes to using your seller credit to lower your interest rate in a buy down. So I'm sure you're out there and you're scrolling through your Facebook feed or your Instagram feed or maybe TikTok, and you're seeing all these people talk about interest rates. But that's not the only thing that factors into your monthly payment. Yes, principal and interest do matter, but 2 other things matter just as important. That's homeowner's insurance and your property taxes. You could end up buying a $400,000 or $500,000 house, and your first year of property taxes might only be $2,000. However, there's a key to this, and that means they're going to adjust to the new assessed value after you purchase. So that following year, you could have an escrow shortage, and that sounds super scary. So remember, when we're talking about property taxes in your monthly payment and your homeowner's insurance, they could fluctuate each year. Just know going into it that they're going to adjust. We're going to talk about those items as well when it comes down to an estimator. We can go through any county in Florida and say, hey, here's what your estimated taxes are going to be next year after this year. We want to make sure that you're set up for success to know that in the future, your property taxes and insurance are probably going to increase, but you're not afraid of when those bills come due. So 2023 has been a crazy year for housing. We've seen interest rates all the way up to 8.5%, which in today's day and age is super high. Not a big deal though. You're also seeing people out there talking about how interest rates have dropped, but there's a lot of factors that go into that. Could your interest rate be in the 6s? Absolutely. Could they be in the 5s? Possibly. There's so many factors that include credit score, your loan to value, which means the money you're putting down on the purchase, as well as your debt to income, which is your debts versus your income. All those things can factor into what your interest rate could be. So just remember, going into 24, it's going to be a great year. When you have interest rates that have dropped almost 2 percentage points, again, roughly saving you about $500 a month from where you were last year, you're going to have a chance to purchase at a much lower payment. Remember though, lower interest rates mean more buyers. You're going to have more competition out there. So you're going to have to work with a real estate agent that really knows what's going on in today's market. They're going to be able to guide you through the entire process. Using a great buyer's agent is going to help you through your home inspection, through your appraisal, through the entire process. So you're a veteran and you want to buy your first home. You have no idea where to start. Not a problem. Some great benefits that come with being a veteran because we appreciate the service you've put into this country and we want to give back to you. One of the benefits of doing a VA mortgage is that you have 0 down. How awesome is that? And then if you have any service-related disability, you also don't have what they call a funding fee. Something that a lot of people don't talk about when they do VA mortgages is that there is a funding fee. Yes, you don't have a monthly mortgage insurance like FHA or conventional, but you do have a funding fee, and that can be up to 2.15%, especially if it's on your first use. So remember that. You're going to spend a little bit of money there. But if you have a service-related disability, you do get no funding fee. Also, a big ticket with that is if you are 100% disabled, You also don't have to pay property taxes. How awesome is that? In Florida, you do have to set up an account and you're going to send that back in, and then they're going to give you your money back out of escrow. However, you won't have to pay property taxes. Those are just a couple of benefits of getting into a VA mortgage. If you're a veteran out there, you might have heard about an assumptive mortgage. Now, for me, you're probably thinking, how is this guy going to help me? Because with an assumptive mortgage, you're actually going to the current lender or bank on that mortgage. So we'll say you found a house and it's awesome. It's $600,000 purchase price. You as a veteran have a chance to assume the current mortgage. We'll say that mortgage is $450,000 at an interest rate of possibly 2.5% or 3%. Nothing that can be touched in this day and age currently. So you're like, how do I go about doing this? Well, for me, what I can help you do is help you do what they call a piggyback second mortgage, right? And in that case, you're going to take the difference of what's left, and we're going to be able to attach that to the first mortgage as a second mortgage. So you're going to say, Ryan, how is that going to work? Why wouldn't I just go with a standard VA mortgage at maybe 6%? Well, when you do the first mortgage, and we'll say 2.5, and you do that second mortgage, and we'll say it's 10.5. Really, the break-even point, you're actually saving money monthly. It's going to actually do better for you. I'm working with a gentleman right now, wonderful veteran, 100% disability, and guess what? We're actually saving him about $1,000 a month in doing a first and a second, rather than doing just the first. So if you're a veteran out there and you're like, man, I really don't know what I'm doing, we'd love to have a conversation with you how you're able to assume a VA mortgage.